I want to talk a little bit about startups and startup culture. In general, this can be a great way to learn business English, as there's this American and British show called Shark Tank. In this show, entrepreneurs in need of investment capital pitch or present their business ideas to successful and wealthy business people. For intermediate learners, some episodes can be difficult, but I think it's worth looking at as you can see business English used in a real-world context and also see the differences in formality and culture between the American and British business worlds. So, to introduce you to the typical vocabulary in these shows, let's talk about startups and entrepreneurs. First of all, the main difference between a startup and a regular business is the difference in their goals, growth strategies, and risk. Whereas a startup seeks to grow fast and thereby disrupt the market, a regular business wants steady growth and long-term stable profits. By the way, startups and investment culture use that word a lot. Disruption. They want to disrupt the market or completely change the way things are done in it. For example, the startup Airbnb disrupted the hospitality or hotel market with their app that allowed regular people to rent out their houses or extra rooms. Startups also need a lot of investment capital to help fuel their growth. But as startups are also extremely risky, as they have untested products and markets, you might question who would want to invest in them. Well, a common idiom in English is no risk, no reward, which is also very true in business. What is also true is that the more risk investors take, the more potential reward they seek. So often investors want to see an ROI or return on investment of 10 times what they put in. In other words, they want a 10x return or ROI. For this reason, investors can push the startup founder to grow fast. And this creates a very exciting work culture that also demands long working hours and tremendous flexibility. In fact, working environments at startups can be so stressful, it often leads to burnout and poor work-life balance. Not to mention, the jobs provide little stability or job security, as there's a high risk that the company fails or runs out of money, sometimes from one day to the next. Adding to this risk, a lot of startups will offer equity in the company in lieu of fair compensation or salary. In other words, instead of a fair salary, employees at startups receive a chance to make a lot of money if the company is successful. For startups looking to grow quickly, several key factors are important. First, having a clear business model that can scale is crucial. This means knowing your market and offering a unique value that attracts customers. This is the disruptive factor we talked about earlier. And as the company grows, it obviously needs to track its KPIs or key performance indicators. I'm not going to go through them all, but in case you watch Shark Tank, here are some terms you'll hear all the time. The customer acquisition cost. As the name says, it's how much it costs to get a new customer. Obviously, if the CAC or customer acquisition cost is high, it will eat into the gross margin. The gross margin is basically the money the startup earns after all costs, and the gross margin is calculated by subtracting the costs of goods sold from the revenue or money coming in. I know that's a lot of vocabulary at once. Let me explain. If a company has 60% gross margin, this means that 60% of the company's revenue remains. This is what's left after covering the cost of goods sold, or COGS. In hard numbers, a company earning $100,000 revenue with $40,000 in costs of goods sold, they would have 60% gross margins. So if a company sells digital products like online courses, they have little to no costs of goods sold, as they pay no shipping costs. But on the other hand, if it costs $50 in Facebook ads for them to acquire a new customer for a course they sell at $50, well, this company is only breaking even. They are not making a profit, but they aren't losing money. Actually, they're probably not quite breaking even, as the software service they need to have online checkout, it will probably charge them 3% of every sale. In other words, on a $50 sale, they will have $1.50 in cost of goods sold. Another important metric, or KPI, that you'll hear investors ask from startup entrepreneurs all the time is the churn rate. This is the percentage of customers who stop using the product after a while. Closely related to this churn rate is the user engagement metrics, or statistics, which carefully track how many users they have and how long they use the application or service. So, for example, when Instagram started, they wanted to track not just how many new users they acquired each month, but how engaged they were, how long they stayed on the platform, and if they made any comments or posted any pictures. And last but not least, another KPI that an investor will surely want to know is the MRR, or monthly recurring revenue. As the name describes, this is the revenue that can be expected each and every month. Tomorrow, we'll look at a specific example of a startup. But before we end today, I thought it might be fun to try a little game. I'm going to describe an idea, and you can answer for yourself whether this idea successfully disrupted the market, that is, if it was a truly successful business and provided 10x returns for their investors. Ready? Here we go. Here's the first idea. There's a company that wants to harness the power of, or use AI to predict the future. With their advanced algorithms, this company can provide other companies information about their likely success in 3 years. What do you think? Is this a real company? No, it's actually not. Not at the moment, anyway. All right, here's the next idea. How about a website designed for college students, where they can rate each other's photos? What do you think? Can this idea be successful? Well, maybe you already realize this is exactly how Facebook started. And now, well, Facebook is basically all over the world. Now that we're warmed up, let's try one last example. What about a company that can edit your genes? No, not your blue genes, your DNA, your genetic data. This company could precisely locate on your DNA where specific traits are and can edit them, can make you bigger or stronger. Oh, and of course, they can cure diseases. What do you think? Sound like a good idea? Well, I'm sure we agree. The idea is good, but is it possible? Actually, yes. And this technology, known as CRISPR, is already being used in research today. And while the ethical issues stop a lot of it from being applied or used in a commercial way, I'm certain some private companies are doing some really interesting things that we don't know about. Well, that's probably enough fun for one day. I'll see you again tomorrow for a closer look at a specific startup. If you're feeling ambitious, check out some of the links to Shark Tank episodes.